We're going to discuss here just kind of lay the groundwork for what these three strategies are. This is thecreditjungle.com.
George of the jungle, strong as he can be.
And it is now time for a little bit of inside the huddle or inside baseball, whatever your preference on sports is. But we're going to discuss here just kind of lay the groundwork for what these three strategies are and give a 10,000 foot view so that you understand what some of the expectations might be for you to be able to take over somebody's mortgage payments that's already in the threes. The first assumption is that number one, you've got a 10% down payment. Now those funds do not have to be sourced and seasoned, and we can explain that when we talk with you what that means, but that money can get pretty flexible on where that money can be coming from. But you have 10% down. Second assumption is that you would otherwise qualify for a loan. Now this applies specifically here to strategy number one. And it doesn't mean that you have to qualify at current interest rates, which are up here. So the higher the rate, the less house you qualify for. As the rates come down and you're trying to qualify for a lower rate, the amount of home you can qualify for goes up. So somebody who's got that mortgage in the threes, qualifying for that, you can look at a little bit more expensive home than what the bank might have told you. I'm sorry, sir, at your current debt to income ratios and current interest rates, you can only look at homes for $350,000. Well, guess what? If that rate is in half, that means that you can roughly look maybe $500,000 in the market. So a lot more bang for your buck. You have a lot more purchasing power with a lower interest rate. And then the next two strategies that we discuss are what if you don't qualify right now? Okay, that's a different scenario, but it doesn't mean that we can't work with you, and doesn't mean that you can't go under contract and get into a home and have this opportunity. And the other scenario is, well, what if the underlying mortgage is not assumable? Roughly 7 times as many loans are not assumable as are. So for every FHA, VA, and USDA loan that's out there, there's going to be 7 times as many conventional loans that are not assumable. Is there a strategy for that? Yeah, even if you don't qualify, even if the loan is not assumable, you can still get a home and take over a seller's payment with a mortgage in the threes. And so those are the things we're going to be discussing here today. And at least the first video is going to get into the first strategy. But the thing that there's not a lot of wiggle room on is that 10% down. If you don't have that, you can still go to the link and apply for a loan and give us your information, and we can look at what other options might be available. Utah Housing, USDA, grant programs, down payment assistance, what have you, but you're going to be dealing with current mortgage rates. But anyway, thanks for coming in. Strap in. We're going to go to the whiteboard now and discuss strategy number one. Anyway, that buyer here, they could get a conventional loan. If they went in there and bought it for $475, put down their 10%, financed $427 at 7%. Okay, as of today, the day that I'm making this video, the interest rates are north of 7. So 7 here is just kind of a moving figure. But the higher that it goes above 7, the better this looks, just so that you understand. Principal and interest, $28.45, taxes, insurance, and mortgage insurance, another $400. This buyer here on a $475 house with 10% down is looking at a nice, cool $3,245 a month mortgage payment. Well, the seller in this case happens to have an underlying, in this case it's going to be an FHA loan, but it could be FHA, VA, or USDA. Now the nice thing about VA and USDA, VA there is no monthly mortgage insurance, and on USDA it's about 2/3 cheaper, or about 1/3 cheaper than it is on FHA. So the mortgage insurance here, well, actually compared to the loans that you would be assuming on FHA, it's less than half of what it is. So the USDA and the VA have a smaller mortgage insurance component, which makes it even more attractive if you can find them, but you're going to find more FHA loans than anything. But anyway, this loan's about 3% fixed. Principal and interest is $1,330, and that's because this loan is 2 years old. We don't have 3% rates right now, but we did 2 years ago. And their mortgage insurance, $220 a month. It's important to know on this mortgage insurance with an FHA loan, it's not going to go away, okay? And that's fine. I mean, this isn't going to go away either. So, if you want to complain about this, then don't complain about this. Probably don't get the best of both with everything. Taxes and insurance, no matter how we chop this up, the seller, the buyer, the existing loan, it's going to be about $310 a month. Now, typically I would recommend that somebody who's going to do an assumption, if you want to pry the buyer out of their house, if they're current on their payments, they like the home and everything else, the way that you would offer to get them out of their house is offer them more money, right? Everybody has a price, and in this case we're going to add a little bit north of 5%, which for the real estate agents out there, that would be about the commission, right? So if you could go out and offer a seller, hey, I will get you full appraised value or full market value for your house and not charge a commission, that's not a bad pitch. And what you're going to do, you're still going to make your commission, but you're going to add it on to the sales price of the home, and the buyer is going to be happy to pay it, and here's why. So the purchase price of the home on an assumption is $500,000. This seller they only owe $300,000. Well, our buyer doesn't have $200,000 to put down. They've got $50,000, but they don't have $200,000. So how do we make this work? Well, the buyer puts down their $50,000, and then we get them a home equity line of credit that works in conjunction with the assumption. This is an in-house product that we have that is actually really, really cool. And I'm going to go over just a little bit of the terms of that. But there's the 50 of it, buyer's money, 150 second mortgage. It's a home equity line of credit. And then they're assuming the $300,000. Well, what are the buyer's payments, and is it really worth the buyer to pay the extra money to get this house and take over that 3% rate? Well, they're going to have the same $1,860 payment that the seller has the payment. This now becomes the buyer's payment. And by the way, the seller, on an assumption here, this mortgage, when the assumption is completed, no longer reports to their credit report. It is as though it was paid off. The liability and the credit reporting all now transfer over to the new buyer. Okay? So there's the $1,860 principal, interest, taxes, and mortgage insurance on here. This HELOC is going to be an adjustable rate. And you're going, oh, why would I want an adjustable rate? Okay, well, let's run the numbers on this. Right now, for a person with above 700 credit scores, they're going to be prime plus 1%. Prime is at 8.5%. That would be an interest rate of 9.5%. Probably likely that the Fed might do 2 more 0.25% rate hikes. We'll find out shortly here before the end of the year, well, by the first of next year, what they're going to do with that. But let's run the numbers at 10%. So 10% interest on $150,000 is an interest-only payment of $1,250 per month. Now on these HELOCs, and I've talked about these in other videos, okay, it's an interest-only payment for the first 10 years, and then it flips over and it will start amortizing and pay off in 15 years. So if you are just completely risk averse and you're convinced that the Fed's going to raise rates to 27%, okay, then don't look at this, okay? And we're going to show another option where you don't have to worry about that. But now we've got a total payment here of $3,110. Okay, well, geez, George, you're saving me on my payment. You saved me $135 per month. I am not yet convinced that to save $135 a month versus going the traditional route, paying an extra $25,000 for the home to save $135 a month, I don't know that that alone is worth going through this process, okay? Well, let's add on something else on here. Closing costs on this loan over here are going to be $6,500 to $7,000. Let's just say $6,500, about 1.5%, almost 2% of the purchase price. The closing costs on this are going to be $1,000 on the assumption on the buyer's side. The seller's going to have a little bit of a fee to pay, but the buyer's only going to have $1,000. So the buyer here is going to save in closing costs $5,500 out of pocket. Okay? Well, now, are they still saving money? Yeah, they are. Yeah, they had another $2,500 down here. This is $50,000 down. This is $47,500. So we got an extra $25,000 down, but we saved $5,500 here. The buyer has $3,000 in their pocket that they didn't have going the traditional route. Second thing on here, the final thing on here, This is kind of a cool part, and this one is, you know, for the nerds out there, I'm just going to explain a little bit about logarithmic functions and an amortization curve. The savings here on this amortization, this is really pretty cool here. So this loan, obviously you have more money at a higher interest rate. And during the first year, that loan, the principal reduction on that loan for the first year is going to be $4,342. That's how much that loan is going to get paid down by, $4,342. Over here, what do we have? We have a lower loan amount to begin with. We have a lower interest rate. The other thing is that we've already picked up the first 2 years of the amortization curve here. Okay, we got an amortization curve that looks like this. That first 2 years, pretty flat line. There's not that much going to principal during those first 2 years. Well, thank you, Mr. Seller, because the seller has already paid the first 2 years, or he's paid that shallowest portion of the curve. So we now have 28 years remaining on this loan. This one has 30. So how much money goes to the principal of this $300,000? Because nothing's going to principal here. This is interest only, right? So we're like, this may not be so good. Well, how much goes to principal during the first, or I'm sorry, technically the third year, but the new buyer, their first year on this, the amount of principal reduction that they have is $6,982. So the difference here, over here, we had about $2,600 more money going to principal, which means that even though we've got an interest-only HELOC here, even though it's adjustable, even though we're kind of running what I think is a worst-case scenario on this, the buyer here is actually picking up $220 a month of additional equity on this one that they're not picking up there. And guess what? As this curve starts going out a little bit further, the numbers continue to get better. So anyway, something to think about. And if the buyer has extra money, if they wanted to take what they're saving here, that additional principal amount, or their savings, whatever they're saving, the $135 a month, this can be paid down. And the nice thing about a HELOC is that if somebody threw a $50,000 lump sum payment against it, okay, guess what? The interest-only payment is based on what your balance was from the previous month. So if you're paying any extra money on it, your minimum payment continues to go down. You can't do that with this loan. You don't have a reamortization feature on an FHA, VA, USDA, or a conventional loan. You know, you throw down an extra $50,000 against this one, that's your payment stays there. You throw an extra 50 grand against this one, your payment stays here. You throw an extra 50 grand up against this one, your payment goes down by a third. Okay, so just keep that in mind and stay tuned, because we're going to show option number 2 on how to have a seller transfer the benefits of their low interest rate mortgage over to you. This is thecreditjungle.com. I'm George Anderson, and I would love to work with you and help you find a transaction like this. We've got the leads, we've got the buyers, we can make this happen for you, and we'd love to have you on our team. Have a great day. We'll talk to you soon.
George of the jungle, strong as he can be.